From my years of experience, the mistake most people make when investing is focusing too much on the short term.
กูรูพอร์ตโฟลิโอแอนดรูว์ สตอสเต็มเปี่ยมด้วยประสบการณ์ด้านการวิเคราะห์หลักทรัพย์และในตลาดทุนมากกว่า 20 ปีเคยดำรงตำแหน่งประธานสมาคม CFA Society ของประเทศไทย 2 สมัยเคยได้รับการโหวตให้เป็นนักวิเคราะห์อันดับหนึ่งในประเทศไทยในปี 2008 และ 2009 ในปี 2013 ร่วมก่อตั้งบริษัท ASIR Investment Research โดยดำรงตำแหน่ง CEO มาจนถึงปัจจุบัน
My name is Andrew Stotz, and I've designed my asset allocation strategies to be low, moderate, and high risk to help you invest for a lifetime. The advantage is that you can switch between these strategies based upon your changing risk levels. My aim is to provide you with strategies that perform over decades so that you can spend less time worrying about your investments and spend more time enjoying your life. My name is Andrew Stotz, and I've been a stock market analyst for 30 years, and I was a head of research and was voted a #1 analyst in Thailand in the past. I was a university lecturer now for 30 years and a 2-term president of CFA Society, Thailand. I set up my own business in 2013, and that's where these strategies are coming from. Now, our strategies are suitable for those who want a low maintenance way to invest for the long term and who want a robust strategy based not on my feeling, but on extensive research and testing. And for those who want to suffer less during a downturn. But of course, to suffer less during a downturn, you have to give up some upside. I want to talk to you about 2 types of risk. The first is volatility, and that's really just the ups and downs in asset prices. High volatility can be emotionally painful. I know, I've felt it many times. But for a long-term investor, volatility is not really risk. Did you hear me correctly? Volatility is not really risk. In fact, it's opportunity to buy low and sell high. Now, the second risk I want to talk to you about is shortfall risk. This is a risk that you don't have the money that you need when it comes time to retire. For me, this is the most important risk, and it's the risk that's not talked about. But I would say it is a risk that I care about more than any other. Now, this risk tells you that only focus on reducing volatility, which sometimes some advisors say reduce volatility. It's a bad strategy. You've got to think about allocating to the market over the long term. So those 2 risks are critical. Now let's talk about reducing the downside and how critical this is for long-term capital appreciation. Our strategies aim to capture as much of the long-term equity return as possible, while also trying to reduce this downside risk. Now, some people take on a lot of risks by buying a few stocks. By diversifying with mutual funds and using these diversified mutual funds, it's like we're reducing risk by wearing a seatbelt. Because we're using these diversified across various asset classes, it's like having an airbag. So diversified mutual fund and diversified across asset classes are the key to reducing risk. Let me talk to you about my FVMR framework. We consider the relative attractiveness of any investment or asset based upon its fundamentals, valuation, momentum, and risk. Now, we do all of our research in-house, and we've done extensive research over the past decade, back testing, where we optimize our strategies to try to understand what worked in the past. What I've learned is you have to understand the past before you start looking forward. Now, it's easy to be emotionally affected by the stock market. The ups and downs can be crazy. And this can cause you to make bad decisions. I've seen it many times, and I've made my share. Now, to avoid this, we stick to our framework. The strategies rely on data and structure rather than just feeling. Now, we're continuously conducting research to enhance our strategies, but our main objective is to give you a set it and forget it strategy. Remember, our aim is to create strategies that perform over decades. Let's talk about the low risk strategy. This strategy focuses on protecting purchasing power by being well diversified across the 4 different asset classes with a moderate amount of stock market exposure. So we use global asset allocation with a balanced focus on stocks, bonds, commodities, and gold, but the core of this strategy is bonds. Now, the low risk strategy is for you if you've seen inflation eating away at your deposits and you want to try not to see deterioration in your wealth. So if you want to outpace inflation a bit and get a little extra return, then this strategy is for you. So let's look at the back testing of the low risk strategy. The target return that we're looking at is about 4% based upon the back testing. Now, the equity exposure was on average about 30%, and bond exposure was on average about 60%. And again, to repeat it, the target return for the low risk strategy is about 4%. Let's talk about the moderate risk strategy as we move up. Now, it's a well diversified strategy across asset class, and we aim to grow and protect wealth with a balanced exposure focused on reducing the downside, ultimately, of an equity portfolio. Now, it's got asset allocations like the low risk strategy of stocks, bonds, commodities, and gold, but the core of it is stocks. Now, the moderate strategy is for you if you're convinced that investing in stock market is necessary to protect and your wealth and make it grow over time. But being 100% in equity is just too much ups and downs for you. So therefore, it's going to protect you from that. So you want a strategy that focuses on downside protection while trying to capture as much of the upside as you can. Let's look at the back testing of this moderate risk strategy. First of all, I'll mention that the target return is about 6%. The equity allocation was much higher than the low risk one at about 67%. And basically, we've ranged between as low as 25% equity and as high as 85% equity. We were down at 25% equity at times of major crises in Europe and other places, but most of the time we're not going to be that low. Now, the back testing results may be different than what we get in the future, but our target return right now is 6% for this strategy. Finally, let's talk about the high risk strategy, where we aim to generate long-term alpha during both equity up and down periods through allocations to asset classes, sectors, regions, countries, and themes. So we get more narrow with this one. Its global asset allocation is more heavily weighted in stocks, followed by bonds, and then commodities and gold. You'll notice that all 3 of our strategies have all 4 of the asset classes, but with this one, we will make more aggressive tilts. This high risk strategy is for you if you're more of a risk taker, or maybe you're younger and you've got more time to let your money grow. Or if you feel that picking stocks, you want the returns from picking stocks, but you had bad experience with it. So ultimately, you want to have a diversified strategy that aims to capture as much alpha or equity outperformance during both up and down periods. So let's talk about the back testing of this strategy. First, I'll mention that our target return for the high risk strategy is 8%. Now you may say, Andrew, what about 15 or 20%? Well, come on, let's be realistic. Warren Buffett, he earned a 20% average annual return when the US market earned a 10% average annual return. Nobody's beating Warren Buffett. And the fact is 10% return is fantastic for most people. So the outperformance relative to world equity could be high because we're tilting into various smaller areas like sectors, like countries. Now the equity allocation averaged about 73%, and it's been as high as 96 and as low as 51%. Again, the target return for this strategy is 8%. So low risk is 4%, moderate risk is 6%, and high risk is 8%. My name is Andrew Stotz, and I've created these strategies to help you manage your wealth for a lifetime.
Guru Portfolio เลือกลงทุนอย่างมั่นใจพอร์ตการลงทุนบนความร่วมมือกับกูรูชั้นนำผ่านแอปพลิเคชัน InnovestX